Welcome to Think Smart with TMFG, the weekly podcast covering the financial topics that are newsworthy and relevant to everyday Canadians. Hosted by Senior Financial Advisor Mike Connon of the McClellan Financial Group of CI Asante Wealth Management Limited, here is today's episode.
Welcome to Think Smart with TMFG. I'm Mike Connon. Beside me is Carlo Cancino, Senior Financial Advisor with CI Asante Wealth Management Limited. So, Carlo, being a successful business owner and building personal wealth are not exactly the same thing. You can have a strong revenue, a business that runs well, clients that love you, and still find yourself in a position where almost everything you have is tied up in that business. So today I want to talk about what actually changes that, what those specific decisions and habits are that turn a successful business into a lasting personal wealth.
Yeah, no, and you've been on both sides of that. You know, you and Rob had founded this company, so you're one of the founders. But as an advisor, you've been also working with a lot of founders over the years. So I guess today we'll just get into what the financially successful ones, what they do differently. When you and Rob were building TMFG, was there a moment when you realized the financial side of being a founder worked a little bit differently than you expected? Maybe something you wish someone had told you a little bit earlier in life?
Yeah, there actually was. You know, I remember meeting with an advisor who had a large practice, and we were, a lot of times Rob and myself would sit down with other advisors, get an idea how their practices run, and just try to pick up things from them. And we're always pretty open. So we put down all our finances to them, right? And we had our business and we showed our profits and everything looked pretty good. Mm-hmm. And when he looked at the numbers, he handed it back. He said, well, what do you pay yourselves? We never put any pay for ourselves. We just took whatever was left over, and that was what we made. And I said, no, we just take whatever's left over. He goes, well, that's not a business. Right. And it really was this point in time where he realized that the business is a separate entity from yourself. And when I find successful businesses that really move to the next level, treat the business as a separate entity than their own personal lives. And that's the true sign that you've actually become a business.
Right. And I guess that's, you know, you look at the two of you having created this very successful business. When it came to, you know, generating revenue for the business and trying to manage expenses, the two of you were very rigid about it, very disciplined, so that there was as much money left over as possible. But when it came to the personal side of things, where you were going to be paying yourself as an individual, maybe it was a little bit lacking.
Yeah, you have to definitely go and treat your personal life. You know, you really need two separate financial plans. We know we're business, obvious. You don't do a business without a financial plan. If someone says they have business with no financial plan, I just tell them they don't have a business, right? So you go back. You're not really a business. But with the personal, it's not as forced in there. And a lot of times business owners think, well, I have a financial plan. You know, my business is all done. I have all my expected earnings, my expected revenue. I know how much you're going to pay my employees. They know all these details, and they know it like the back of their hand. They can tell you, if you ask them on the street, they'll be able to give you all these numbers. Mm-hmm. But you ask them what's going on in their personal life, they don't have a clue. Right?
Well, do you think it's because there's maybe a little bit of a mix between, you know, what personal expenses can be put through the business and what can't, and so it's a little bit confusing?
Some of it gets, it gets tricky because from a tax point of view, you like everything goes through the business, right? Yeah. So obviously everything can be tax deductible. You'd like to be tax deductible. Right. But when you stop worrying about the little things like that, there's a more important big picture in how you're going to survive in the long term. It's more important than being able to write off that little expense. Sure. Is more importantly that you have a long-term financial plan to take care of things.
Right.
When we talk about treating businesses separately, you know, I looked up a stat. It was on ISED Canada, which gives you details on businesses and how they've done. Do you realize that after 5 years, 62% of businesses success last the first 5 years? When you take it out 10 years, and these are small businesses, right? Only 44% of businesses make it after 10 years. So when someone comes up with a business, there's a chance of it going bankrupt. Right. And businesses go bankrupt all the time. Mm-hmm. But a business bankruptcy is very different than a personal bankruptcy. And this is why you want to keep these entities. You can't go and say, my whole life is dependent on my business being successful if we know there's only a 44% chance of that working out. We take on someone. So these are things that you have to go in. it's almost like when everyone goes to get married. This is our most difficult advice, right? We want to act like they're going to be married forever.
Right.
We know only 50% of marriages
Yeah.
last forever, right? So
Right.
you don't want to, no one wants to poke that elephant in the room.
Mhm.
And when you're sitting down with a newly wedded couple, you don't want to mention the stats on it.
Yeah,
and when you're sitting
exactly.
down with a business owner with their eyes glowing at what they're going to do,
Mhm.
you again don't want to bring up these stats. But again, with a marriage, you go and we try to protect clients with doing prenuptials and that stuff, or
Right.
or a agreement in there to make sure they're protected. Same thing with a business. You got to
Mhm.
make sure your client's protected and make sure that we know these stats in the background. We
Mhm.
hope all the best. We hope it's going to work out. We have some protection in place just in case they become part of the statistic.
Right. And that's all the more reason to get your personal financial planning in line. Because, yeah, you could have these amazing ideas for these businesses. 44% don't last. So if you put your heart and soul and all your resources into it, and it happens to be one of the stats, and you have not taken care of that personal side, you can recover from a business standpoint, but not necessarily from a personal.
Yeah. You begin to realize businesses are a lot like marriages.
Yeah.
They're
Yeah.
pretty closely related.
100%.
So what does it mean to approach your personal life as a, let's say, personal CFO what would you say that would mean?
Well, I think if you were a CFO, you're trying to manage, the income statement. You definitely want to know what you're bringing in from a personal standpoint and what was going out, and ensure that there was money left over, like profit, to set aside for when you stopped working. And so you have to be incredibly disciplined, as a CFO would be.
Yeah. And the same as a CFO is trying to create the future of a business.
Mhm.
For your personal life, you want to create the future of yourself to make sure it's successful. If you go into that thinking that way, you will be very successful because
Right.
you're going to make more rational decisions. We're always talking about emotional decisions versus rational decisions.
Right.
And we need something that goes and pushes you over to the rational decisions. So a lot of times, as we said, people work in the business, it's all rational.
Right.
And they go in their personal life and they're all over everywhere.
Yeah,
right?
pretty emotional decisions.
Yeah. So the first point is, if you're going to treat your personal finance like a CFO, is figure out how you can get money into this, let's say, personal company. Let's say, let's call it, there'll be the TMFG, and then there's me, Mike Connon, right?
Right.
So how is Mike Connon going to get money?
Right.
And you have to make some deliberate decisions on how you're going to get money out of the company and how
Mhm.
you're going to be paid, how consistently you're going to be paid, and what tax format you're going to be
Mhm.
paid. If it's going to work better for your future pensions, if you want to get money at the lowest tax rate,
Mhm.
how it's going to affect the company's taxes inside it. And there's all these different factors to how your pay is going to affect both the company and yourself personally.
Mhm.
We always think if you take dividends, it has some tax preferential treatment, but
Mhm.
again, no CPP contributions,
Right.
no RSP room,
Mhm.
right? So again, you're losing a bit. It's a quick fix, but later on, that doesn't help your personal situation as
For
much.
sure.
So, and again, dividends are nice, but they're not a deduction for the corporation. So again, you're paying more tax on the corporate side of things. So there's a fine line. Dividends are great. Trust me. They're
sure.
great.
Yeah.
It's a great
Yeah.
strategy. I'm not saying it's not a great strategy,
Mhm.
but you need to look at all the different options available in there.
So what would be another way to get compensated out of the business? We talked about dividends, so you're pulling that out. Unfortunately, you're not getting the CPP contributions. Typically, you're keeping them relatively low. And on the personal side, if you're looking to borrow, doesn't necessarily help when you're going to a financial institution if you're, managing your expenses to be low.
Yeah, I make lots of money.
Manage your income to be low.
You go to the bank manager and try to explain to them what you're doing, and they'll give you a little bit of a dirty look.
Yeah.
Because people are sometimes even pulling things out of the company that either are return of capital and things like that,
Right.
and it's really not showing up in any type of income statement. Even inside the companies, if you want to create pension plans, you have IPPs that you can create inside a company, and that's a use of cash flow that goes and takes care of the future you. Again,
Right.
You're taking the corporation to support your later personal wealth. So there's a lot of things can be done in there too. Also insurance, these are other ways where you can have the company support the future you and the future family of yourself.
Right.
So there's a lot of different options in there. Everyone wants to see the solution in there.
Yeah.
It's so different for everyone. Every company is different. Every family situation is different. Every person is different. So there's really not a solution we can give you on a podcast like this, but we can tell you there's lots of different options, and you need to be sitting down with someone to look at them.
Definitely. I mean, we were just talking about the ways to get money out of the corporation, whether it's a dividend or a salary. I mean, there are different ways that's going to impact the taxation of the business, but also from the personal side. So you've got to look at it from both perspectives, both business and personal. So it's really important to talk to somebody like us before you start making those strategic moves.
What happens is most founders decide how they pay themselves based on what's convenient and what's easy. The ones who build wealth decide on what's optimal. So rather than just say, what's the easiest way to get money out? What's the most optimal way to get money out of this company? And that's a big decision. And again, you need to work with not one professional. You need financial advisors and accountants.
Yeah.
And I mean, we have trouble making these decisions without sitting down with someone's accountant. First thing I'll do is, let's see what your accountant has in plan. And the accountant is great on thinking, okay, what we're doing right now. And then a lot of times we sit down with the accountant, we say, okay, I'm thinking of 5-10 years down. I'm the financial planner. So we're thinking 10 years down the road. How's this going to work out? And the accountant says, okay, right now, this is what we can do. And then we go and work with him and say, okay, here's what I want to get to. And how can you make that happen inside of here? They'll give us directions. Together, we always figure out the most, again, optimal way to get money out of it.
We're working as a team. So the accountant who may be looking at your tax strategy on an annual basis should be working with the financial planner like us, who is looking at the more long term to make sure that everything that's being done on an annual basis is working in the same direction as what we have from a long-term personal plan.
The next thing we talk about is debt. Every business has different amounts of debt. If let's say you're a highly capitalized business that takes a lot of money for inventory, buildings, things like that, debt's part of the game, right? We're in a financial business, so we know money. Debt isn't as much part of our business. But if I had to have factories and buildings and massive inventory, I need to take on debt. Debt is not a bad thing. In a business. It's a necessary part of running a business. In your personal life, debt's not as necessary. It is sometimes you're buying a first home and things like that, but it's also not helping you out as much as whenever you're taking on debt in a company, it's to make more money.
Right.
When you take on debt on a personal level, it's to have more things, right? There's a difference between make more money and have more things. And this is what you have to realize in the corporate side of things. The only thing that's very fuzzy is when you're starting off a corporation, many times they won't collateralize the debt and they're going to require you to sign personally for
some
of your stuff. So, what we say and what the banks say are two different things. We say, don't ever, keep the business at the business, but no one's going to loan you money if you don't have any type of protection there. So many times those two get mixed in together. And the sooner you can get those unmixed, probably the better.
Yeah, no, you're right. Debt is not a bad thing, like you said. It's a vehicle that can be used, like you said, within the business to create income, to build assets. You never want to have debt, whether it's personal or business, for consumption.
It's very tricky. I have one of my friends who had a company, and I remember talking to him about, investing. There a lot of cash in his company. But in his business, cash was king, right? And it was hard to get cash loans because he would make money off buying things and reselling them. And the cash financed that. So for him, the cash in the company and whatever debt he could get, he could turn about a 20% profit on having that. It's just a matter of how much money was available to them, right? So it's a different type of business. So sometimes that debt is very necessary. But other businesses, I watch people who are sitting with hundreds of $1,000s sitting in a cash account in their corporation for no real reason. You go, do you have any expenses that are going to surprise you or come up? No. It's just laziness almost, It sits there. It's not doing anything. It's not working for them. It's just they haven't really thought about it or they haven't met with anyone that said, let's go and put this to use and create an investment account or something or holding corp, something like that inside the company to make that actual money grow.
You want your capital to be working the hardest for you, whether it's personally or within the business. If it's not necessary for a short-term expense, or you're not looking to make a new hire in your company, you want to have the cash available there. Yeah, you need to be earning more than a bank account to, for just to outpace inflation.
That's part of the business, right?
Yeah.
So the next point successful founders do is using insurance as a wealth tool. And insurance, we always think of as protection against someone passing away. It's usually an income protection on a personal side of things or some type of estate planning. Inside the company, it becomes a whole different item, right? There's lots of different types of insurance. We have key man insurance, and that's if you have an employee that's integral to your business, you want to make sure if something happened to them, you're able to afford to replace that situation. There's overhead insurance, right? Overhead insurance is very important. If you're in a situation where you become disabled and you have massive overheads, you don't want to have some disability takes you out. If someone's in a car accident and they're a dentist and they can't practice for 6 months, all of a sudden you can't have your office closed down, lose all your clientele, have to rebuild just because of some type of accident that happened along the way. There's corporate-owned life insurance, which again is a way of getting money out of the company if you have partners in there to make sure that the cash flow and the liquidity is inside the company in case something was to happen to someone where you could buy out the company from the family. Otherwise, you may have partners you don't really want to have in that case. So there's a lot of different reasons for insurance. And even from an estate planning point of view, it really makes sense to be able to get that money out of the corporation in an insurance, which can be, let's say, a tax-preferred way to get money out of your company. There's something beautiful in corporations called the capital dividend account. And that's where, if people don't know about it, that's where the second half of your capital gains goes to, and also any insurance proceeds, which is a tax-free account where money can be taken out of the business on a tax-free basis. That gives you a tremendous advantage in the company to own these insurance policies. And remember, the company is paying the insurance premiums. So again, it's not tax deductible for the company, but again, it's before you get the money out of the insurance. Before you get the money out of the company. So it's not going through that tax wall, and you do have the insurance advantage. So next point is to know when to stop reinvesting. It's how you start to put everything back in the business. That's where everything is going. You're really in a growth stage. At what point should you stop doing that?
Well, that's a tough one because I think it has to do with, again, we have to think about the personal side and what that looks like. When are you continuing, depending on the age or how long, what kind of runway you have when you want to walk away from the business? When do you start taking some of that money out to build up that personal side as opposed to it staying in the business, continuing to grow? At some point, I'm assuming that you want to walk away and have time for yourself.
Yeah, it was funny. Originally, I remember when Rob and myself started, we never thought there was a value to our business. Right. It didn't even, all we were doing was trying to pay the bills, right? So it was just a matter of what can we make this month to get by to the next month. It was to try to create a paycheck. That's what business is for.
Right.
I want to create a paycheck that I'm in control of rather than have someone pay me a salary. That was this. There was no long-term valuation or anything on the business. They weren't worth anything. We didn't have any money under management. So we went through that growth stage, and all of a sudden we realized that there was a value to the business. And there is that stage that you go from growth to more interested in valuation of the company.
Right.
So, and there are two different things because it's a very different model.
Yeah. Well, so you were talking about it earlier with you and Rob, when you'd essentially, the company would generate revenue, you'd have expenses, whatever was left over, you would essentially just take out. That was your income. Whereas when you aren't taking all of the money out and there's money staying in, there's retained earnings, you've got a business that's creating cash flow and there's a valuation to the business. And so that's when you have that discipline to only pay yourself a certain amount, whether it's in dividends or salaries, then you start to see that valuation of the business you're talking about.
Yeah, it was funny. 2007, 2008, during the financial crisis, it was rough for everyone in the business, right? It was just, it got us, it sort of shocked everyone. Because the problem is, as you're taking everything out of the business, when you hit a rough market, you're in a rough position. We went through that. It cost us a lot of gray hairs and a lot of things that we went through during that time. We had to close an office. We had to do a lot of adjustments to make things work. And afterwards, we got through it, and the market started to finally pick up. We saw them picking up. And we owe it to Michelle, because Michelle came up and said, "You guys are stupid," right? And says, "Why don't you save some money in the business?" And Rob and myself both looked at each other and said, "Yeah, we're going to start to go and create a fund and start to save a percentage of what we make into the business." And we started doing that from that year on. We understood that a part of the money that we made didn't go back to us, and we kept it inside the business. Now, it really changed. It's one of the big changes in our business was doing this, because it allowed us to do. We were able to buy property at a point.
Right.
When we moved into the office, we were able to fund renovations and things like that. Through that, we could actually have a fund that we could deal with. Even if we went through poor markets, we wouldn't have to go and start cutting back and laying off employees and shrinking. We could actually go through a poor marketplace and still continue to expand our business. And it was mind-blowing. It took 3 or 4 years to actually get this where it started to become a fund. But then later on, we had something to work with in the company. And it's made life a lot easier. But it's hard to tell people that because everyone wants to take out everything they make.
Right. So if you were talking to a younger advisor who was just starting their business and they wanted to understand what's the right move, I've got a 30-year time horizon in the business. I'm generating X number of dollars of profit. How much should I be taking?
It's tricky. As we said, the first stage is growth.
Right.
So sometimes everything goes back into the business. That can make sense. But once you start to move beyond that stage, you got to have some type of savings inside the business. And maybe it's 20%, maybe 10%, depending on the business. But again, you got to remember, once you understand you get an investment account inside the business, because we always say to people, you should save 20% of your net worth.
Right.
So let's tell a business the same thing. Take 20% and see if you can put it in something that goes and sustains itself to keep that in there. And the great part is you're not forced to just keep it in cash. You can investment account, so it can grow the same as your personal net worth, right? It's just growing inside the business. And generally speaking, the investments are liquid. So if you need to bring it back to the business, you can always go and do that at any stage. But you need that growth happening inside the business.
Right. And I guess you're diversifying your asset as well, because you've got the business, which is an asset that's providing cash flow and providing profits to the company. But now you've also got an investment within it that could be completely disassociated with what the business is. And so you've got a couple of different assets growing. Yeah.
So today we talked about things that financially successful founders do differently. Number one, they treat personal finances with the same discipline as their business. Number two, they make deliberate decisions about how they pay themselves. Number three, they use debt as a tool rather than a habit. Number four, they use insurance strategically as part of a wealth structure. And number five, they know when to stop reinvesting everything back and start building wealth outside their business. And I think that's what ties all these together is intention. I look back through successful clients we've seen, the clients who have done that and again, looked at themselves as a separate individual from their business and made sure they put as much attention to making sure their retirement's going to be good as they did to their business be successful, end up in a great life.
Yes, and that's what I've seen as well with those business owners who we work with. They typically reached a point where they look back and realize that the business, it gave them purpose, income, identity, but the personal financial side didn't necessarily keep the same pace. And that's a gap that's much easier to close when you start earlier than when you think you're about retirement as a business owner. So if you're a founder or a business owner who recognizes yourself in any of what we've talked about today, whether it's the compensation structure, the reinvestment habit, or just not having a personal financial plan that's separate from your business, please feel free to reach out to us. You can visit us at tmfg.ca or call us directly at 905-771-5200. And if you have any questions or other topics you'd like us to cover in a future episode, leave a comment.
Thank you very much. That brings us to the end of another episode of Think Smart with TMFG. Have a great day.
You've been listening to Think Smart with TMFG with Mike Connon of the McClellan Financial Group of CI Asante Wealth Management. Don't forget to subscribe to Podbean, Apple Podcasts, Spotify, or YouTube Music, and leave us a review. For more insights and resources, visit tmfg.ca or follow the link in the episode description. This program was prepared by Michael Connon, Senior Financial Advisor with CI Asante Wealth Management Limited. This is not an official program of CI Asante Wealth Management Limited, and the statements and opinions expressed during this podcast are not necessarily those of CI Asante Wealth Management Limited. CI Asante Wealth Management Limited is a member of the Canadian Investor Protection Fund and the Canadian Investment Regulatory Organization. This show is intended for general information only and may not apply to all listeners or investors. Please obtain professional financial advice by contacting us at 905-771-5200 or visit tmfg.ca to discuss your personal circumstances before acting on any information presented.